Hello, this is Bill Scheid from Applied Finance Research, and in this video we're going to talk about gold, capital flows, and the big cycle. And we're going to get into a Ray Dalio interpretation of what the recent trade data coming out of the US is really telling us and what it means for our monthly systems. So earlier this month, the US Census Bureau and the US Bureau of Economic Analysis released the US International Trade in Goods and Services Report for 2025. And right here on page 2 of the PDF is quietly hidden what I think is a very interesting statistic, and that is that non-monetary gold made up nearly 90% of the rise in exports in October 2025. Now, what is non-monetary gold? What does that number really mean? What's it really telling us? And why should we care? In other words, what does it mean for us as monthly systems traders? Well, first of all, let's take it one at a time. What is non-monetary gold? So non-monetary gold, that's all gold transactions excluding gold being held by central banks. And that's because asset transfers between central banks usually isn't calculated in these kinds of trade data. So basically, non-monetary gold includes all other gold transactions like bullion being traded by banks and funds and refiners and dealers. It's gold bars being shipped back and forth from vaults in London, Zurich, New York, etc. It's gold used for investment products like ETFs, like bars, like coins, etc. And it's gold for jewelry or industrial use. So when they said that gold drove 90% of export growth in October, what they're really talking about is privately owned investment and commercial gold moving across borders. Now, what is the trade data really telling us? What does this actually mean? Well, I recently read 2 outstanding books by Ray Dalio in which he talks about how nations succeed and fail and how they go broke. These books are really exhaustive analyses. They're super impressive. And in these books, he talks about a lot of things, but he talks a lot about gold capital flows and how it fits into the big cycle of the rise and fall of nations and empires. So here's my interpretation of Ray Dalio's interpretation of what the trade data really tells us. So first of all, I think he would say that what we're looking at here is a private sector confidence shift. In other words, institutions and investors are reallocating towards gold as a store of value. And I think Ray Dalio would say that this sheds important insights into global market psychology, and especially the fact that private investors are choosing real money over promises, right? Fiat currency is nothing more than a promise printed on a piece of paper. And I think Ray Dalio would also say that a trend like this is exactly what you would see in the later stages of long debt cycles. And here I'm talking about the incredible amount of debt that the US federal government is currently carrying and continues to increase. I think the second thing that Ray Dalio would say is that what we're actually looking at here are capital flows just masquerading as trade. And why is because gold exports are not about producing goods. They're about moving wealth, they're about settling imbalances, and they're about repositioning capital defensively. So I think he would say these trade data are actually capital flow data. I think Ray Dalio would also say that this connects to currency and real rate expectations. In his book, he talks about large private gold flows usually coinciding with low or falling real interest rates, concern about currency purchasing power, and rising geopolitical or financial risk. And I think all of us would probably say we can feel that there's definitely more uncertainty now geopolitically than there has been in quite a long time. And finally, I think Ray would say that this is an early stress indicator. It's not a crisis signal by itself, but it's an early warning that trust in paper assets is eroding. The system is becoming more fragile as a whole. And I think he would also say that this is an indicator that we are in the late stages of what he calls the big cycle. So again, that's the cycle of how countries and empires tend to rise and fall. And in the late stages of the big cycle, we often see governments increasingly rely on money creation to manage unsustainable debts. Real rates tend to stay suppressed. Financial markets become policy driven and volatile, and also currencies weaken while capital shifts towards real assets such as gold. So what does all this mean for our systems? Well, first of all, macro regime shifts tend to persist for a really long time, and then they can transition very quickly. And all of that means that our systems have an edge because, first of all, they're adaptive and they're rules based. They can capture gains across a variety of markets and asset classes, including gold, like we're seeing right now. BMR 21 is holding a position in GLD. Our systems also don't rely on prediction. They do an excellent job of playing defense, which we see when we look at previous market crises such as the 2008 financial crisis or the COVID crash. And we also know that our systems do a great job of reducing emotional and cognitive load in periods of volatility. So if we're going to get into a lot of market volatility as we get later and later into the big cycle, that's going to be very, very important. I also think that systems that rotate into assets like GLD are effectively responding to changes in real rates and currency confidence, even if the signal originates from price action and momentum rather than macro data. And I think that's important because remember, one of the key beliefs behind our systems is that price is the fundamental language of the markets. So we're not so concerned about macro data themselves because whatever the data say are going to show up in price, and price is the final and fundamental language that we care about. I think that gold showing up in the trade data reinforces that GLD is not just another trade in our monthly system, but it's actually an expression of our systems adapting to monetary stress conditions. So I think our systems are already doing a great job of being adaptive. And finally, I think that in late cycle environments, correlations between stocks and bonds can rise. So holding GLD improves our true diversification at the system level, which for me, I think is very, very important. This is Bill Scheid from Applied Finance Research. Thank you very much for watching and happy investing.